Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. This is a slightly shorter episode, more of a real-time market update. The Bank of England has once again held the base rate, and at the same time we're seeing inflation proving stickier than many expected. So the obvious question is, what does this actually mean for the UK residential property market? Because headlines tend to simplify things. Rates up, bad. Rates down, good. But the reality is far more nuanced. And that nuance is where opportunity and risk actually sits. Part 1. What the Bank of England is really signalling. When the Bank of England holds rates, it's not inactivity. It's a signal. And right now, the signal is very clear. They are not yet confident inflation is fully under control. Even though headline inflation has come down significantly from its peak, core inflation, particularly services inflation, is still elevated, and that matters because services inflation is driven by wages, and wages are harder to bring down quickly. So what the bank is effectively saying is we are not ready to loosen conditions yet, and that means interest rates are likely to stay higher for longer than markets initially hoped. Part 2. Why this matters for property. Interest rates influence property markets through one primary channel: affordability. Higher rates equals higher mortgage payments. Higher mortgage payments equals lower borrowing capacity. So in simple terms, higher rates suppress demand. But that's only one side of the equation, because property markets are not just driven by demand. They're driven by expectation. And this is where things get interesting. Part 3. The psychology shift. Over the past 18 to 24 months, we've moved from rates will keep rising to rates are likely at or near their peak. That shift is important because property markets don't wait for rate cuts. They move when certainty returns. Buyers don't need cheap money, they need predictable money. And right now, even though rates are still high, the direction of travel is becoming clearer. That reduces hesitation. Part 4. The supply constraint. While demand has been affected by rates, supply has not meaningfully increased. In fact, in many areas, developers have slowed new starts. Planning remains constrained. Build costs remain elevated. So we have a situation where demand is suppressed, but supply is also restricted. That creates a floor under prices, which is why we've seen the UK housing market prove more resilient than many expected. Part 5. The emerging opportunity window. Periods like this often create what I'd call asymmetric opportunity, because sentiment is still cautious, financing is still expensive, but downside risk is reducing. This is typically when disciplined investors begin positioning, not aggressively but selectively, because once rates begin to fall, competition returns quickly and pricing adjusts before most people feel comfortable. Part 6. What sophisticated capital is doing. Institutional investors are not waiting for the perfect moment. They are asking, is inflation trending down? Are rates stabilizing? Is downside limited? If the answer is yes, they begin deploying gradually, because timing the exact bottom is not the objective, participating in the recovery is, and that's a very different mindset from retail investors. So where does that leave the UK residential property market? We are not in a boom. We are not in a collapse. We are in a transition from uncertainty to stability. And in property markets, stability is what unlocks activity. Thanks for listening. And remember, property markets don't turn when rates fall. They turn when uncertainty does. I'll see you in the next episode.